In this episode, we're talking with Philip Tapsell from XDI Systems, which is part of the Climate Risk Group. And we're going to explore how climate risk is being measured in the property space and how seriously it's being taken by lending institutions and insurance companies. How close are banks to pricing in climate risk with mortgages? And where are areas or zones most at risk of becoming uninsurable or simply too expensive to insure? Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent and buyer's agent mentor, co-host of Foxtel's Location Australia, author of Auction Ready and co-host of Your First Home Buyer Guide.
Hi, I'm Chris Bates, mortgage broker, currently ranked number 3 in the MPA Top 100 Mortgage Broker Awards. Before we get started, everything we talk about today is not personal advice, and we recommend you engage the services of a licensed and experienced professional.
Our guest today is Philip Tapsall. He's the Head of Corporate and Finance Sector Engagement, XDI Systems. XDI is part of the Climate Risk Group and a company focused on quantifying the cost of extreme weather and climate change impacts to physical assets. XDI's data helps decision makers and asset owners to manage these impacts and identify opportunities for adaptation. He's also the General Manager of Climate Valuation, part of the Climate Risk Group that helps individuals and communities to understand the risks of climate change to their homes. And he has a background in climate policy, finance and engineering, and has worked in the intersection of climate change, finance and corporate strategy since 1999. You may never have heard of him, but he's got over 20 years' experience in financial services, international NGOs and consulting, including working at ANZ, Westpac, HSBC, WWF India, I can't even say it, and in institutional banking. And he's like going, yeah, stop it. But we wanted to give the credibility, Philip, so we want to give the listeners your credibility, and it's a topic that we've been wanting to gain a greater understanding of. So thank you so much for coming along and joining us today.
Thank you. It's nice to be here.
Look, let's start. I won't try to say that company name as well because it is a mouthful. But what made you leave the banks and that long-worded company name to actually join small business? And it's a really interesting place that you're playing.
That's a really good question. I've been involved in thinking about policy response to climate change for some time. I mean, it's go far back as uni. And there's different ways that if you're interested in this topic that you feel like you can make a difference. So one might be that you take quite an activist and confrontationalist approach to this. So obviously some NGOs who work in that space. We've seen activism for a number of years. Others might prefer to work in sort of intergovernmental organizations trying to change policy from the top. And others work within companies seeking to change the agenda or influence the board, senior management decisions, and really set, I guess, strategies that turn the big wheels in the economy, and with the hope that then trickles down or out, radiates out into the economy to affect other change. So my old boss used to call these innies and outies. You're either in the system or operating outside of it. The appeal that XDI has for me, and I think many people who work there, is that we're working within the system, but also challenging it to be better in the sense that we can put on the table pretty compelling data and insights that say, look, we know you're doing good stuff, but this risk is becoming quite material, and not just putting risk on the table, but saying, well, here's what you might do about it. And it's that kind of agency-based approach, or giving people the tools and capability to respond, that's appealing. I can get a little bit more into the detail around how our analytics work, but we're not necessarily just trying to shock people. We're actually saying, well, here's the issue. We've got time to think about it. Here's some tools that will help us navigate that. So yeah, that's how I got into that.
I mean, there's always things that we get passionate about. There's what's the things that Philip gets really passionate about when we're talking about sort of this area that you're sort of known for, that when the conversation comes up about that, you're going to have some big thoughts on it. I mean, in relation to sort of climate and property per se, ideally, what are the things that are your major concerns, I guess?
Look, it's a broad topic. It's interested me personally because it brings so many different factors together that is sort of a stimulating problem to solve and think about. But when you get down to the question of the intersection of climate change and property, we're really talking about people's homes. We're talking about probably their biggest asset and probably the most significant investment that they might make in their lives. And there is increasingly compelling evidence that climate change may have a material impact on the value of that investment or the security of their shelter or the community, which probably, for various reasons, doesn't get talked about as broadly or as deeply as it might, or the conversation's not as mature as it could be. And I think that can leave consumers and people at a disadvantage. So, part of the mission that we have at our company is to address those asymmetries of information and to make that data available so that it's not just large banks or insurers that have this data sitting internally that they can kind of make the best decision for themselves, but also so that people can think about independently, form a view on whether that's a wise investment for them.
It's fascinating for so many reasons, but like even the fact I think that the institutions have had access to a lot of data for a long time that maybe they have or haven't acted on, or maybe they have or haven't been formulating policy based on, or maybe is or isn't, showing through in terms of their products and services that they're offering to the marketplace. So I'm thinking here specifically, insurance companies, I guess, would price in risk a lot quicker than maybe banks would. I mean, and I'm making an assumption here because I'm not in that space. But at the same time, you've got these organizations that have this growing mountain of, I guess, information. And I know that it's filtering out there into the buying public that to start thinking about, well, maybe I should check part of my due diligence. I need to check, say, with an insurance company as to what might my premium be if I buy this particular property. Like that's just starting to become a thing. But there's quite a lot of change happening. What I've noticed is flood maps have been redone recently. And I don't know if you can talk to that, but I'd love to hear a bit more about why and what's behind that. But so even when we're doing our due diligence and buying a property, for example, we might be working on certain information that we've always relied on in the past, but very quickly it might be superseded or very much outdated. So can we talk to some of that when you talk about information asymmetry, I mean, that's sort of, somebody knows why flood maps need to be redone. And so that's sort of, that's something that maybe the consumer might need to think about.
Yeah, there's a lot of good work that gets done to kind of capture the historical effects of extreme weather patterns that then gets fed into updated flood maps, and they get brought into planning decisions. And when we're talking about some of those flood maps that you're referring to, they are what does a 1 in 200 flood or 1 in X flood look like today? That's fine. Like you can appreciate why there might be a lag, but you can also think why that might be difficult for homeowners to swallow. But there is a lot of work that goes into developing flood maps. A lot of IP. They're extremely expensive, and that might be an obstacle to councils. I probably couldn't comment on why or why not they on their reasons behind that. But what we're trying to do is then say, well, even if you take that current day picture of a flood pattern in a certain area, then if you overlay climate change on that, it looks a bit worse than even the latest present day flood map. And now people might say, well, that's pretty hard to predict. There's a lot of variability within that, and that's true. But as the science gets sharper and, frankly, events start to bear out some of these estimates that scientists have been warning against for many, many years through various bodies like the IPCC, when you bring that modelling down to the scale that people can start to consume it. In other words, it's not lost in the policy debate, but it's actually concrete about their homes. So that's what we're trying to take those big data sets and bring it down to say, well, yeah, the current flood map might say something, but if you put a reasonable assumption around climate change on top of that, then this looks even worse. And that's the conversation that we want to trigger, because it's not one party. It's very difficult to point the finger at it's the banks or it's the insurers or it's the government. When we're thinking about a response to this, it's actually trying to bring multiple parties around this, because the insurers can do so much, the banks can do so much, local councils are inhibited as well. But what we need is a mature conversation. At the moment, what I fear is that each party within that equation is dealing with the matter within its own four walls. And what that means is that a bank might rationally start putting different conditions around lending into high flood prone areas, or insurers might start repricing. It's not withdrawing insurance, but it's making it pretty hard for people to buy as a natural financial response to mitigating that risk within their own four walls. But where does that leave communities? Where does that leave people if they can't access insurance products or mortgages under the same terms that they assume? So bringing these sorts of insights to the table is really what we're hoping to, drive a more coherent response. Just to give you an example of that, in New Zealand, for example, it's quite different. They obviously have the experience of the earthquakes over there, so they need to think about, well, what are responsible management of that sort of extreme event. But they've also applied that thinking to climate change, and I've seen some papers that the government has been discussing where you could think about identifying parts of the country where it really doesn't make sense to build any further, or even thinking about what does a managed retreat of the existing community look like well ahead of time, so it's not some sort of socially disruptive activity. And then there might be another part of the country where this part is, we can think about what investment is needed to make those assets more resilient, a thing called climate adaptation. And then there's another part which is totally fine. And so that's a kind of mature way of thinking about it. Like, we recognize the problem, let's divide this up into a response and then start to fund it. Whereas I fear here it's a little bit more disaggregated, and perhaps we haven't got to that point of having a wide-ranging discussion.
Are we just like kicking the can down the road? She'll be right, mate mentality? I mean, are the banks all saying, well, we're all in on this, we don't want to start bringing lending restrictions in because that will limit the amount of buyers, that'll affect asset values. Ultimately, there's not much equity in a lot of these places. I mean, they do bring postcode restrictions in. They do bring, restrictions around minimum floor size and, high density. And so the banks aren't, haven't got the systems to not do this. I mean, they could easily be putting in restrictions on postcodes and streets and blacklisting areas. Do you think that it's they're all waiting for someone else to do it, but once someone does it, then they'll all follow?
I think there's a few dynamics that are going on. So firstly, the regulators themselves. So we work with a lot of central banks around the world, and they do these things called stress tests, which essentially set a piece of homework for the big banks in their jurisdiction, and they say, tell me what your balance sheet looks like under a climate change scenario of X, Y, and Z. And that scenario could be rapid decarbonization, or it could be a massive flood. So we've seen examples in Singapore where they've said, tell me what a 1 in 200 flood looks like. Tell me what your balance sheet looks like if we put a 1 in 200 flood across ASEAN. Or in Malaysia, they're saying, tell me what a 1 in 200 flood looks like, and how does your balance sheet stack up? So there's increasingly more, there's an increasing ratcheting of regulatory interest in this space, which if the banks weren't cottoning on to it already through their own prudent risk management, then certainly the regulators globally see this as a risk to financial stability globally. So their mandate is financial stability. So they're thinking climate change has systemic impacts. We need to start testing for this. And so that regulatory stimulus is driving a lot of activity at the banking level. The insurers are often captured by that as well. And so there is a growing level of awareness, expertise, capability in-house, like people in-house who are starting to look at this. And it's still very new. So it is, as much as climate change has been in the debate, you could go back a very long time, in terms of its crystallization into a business risk and something that the board should be looking at, it's still a relatively new area, and it does take time to build up the capacity to look at this stuff. But what it tends to accelerate it is either more regulatory stimulus, or extreme events where people go, okay, now we're taking a financial hit. This isn't theory anymore. So the LA fires, for example, are something that's been very, I think, a bit of a wake-up call for people. So, yeah.
Even our floods that we've, over the past couple of decades, there's been significant flooding in Brisbane and Lismore, two areas. Sydney, Melbourne, where we've had significant floods, significant property loss, damage. In some places in Brisbane, you've got relocations. I think Lismore as well, you've got relocations. A bit like in New Zealand, where in Christchurch, some parts of Christchurch are now, you just can't live there. You can't have a house there. But it's funny because we interviewed a historian, Margaret, forgotten her name
Cook.
for a moment, but it was
Marvin Cook.
Thank you. She wrote this amazing book called Brisbane, a river with a city problem, and it gave the whole history of development in a floodplain, and where money basically overrode sensible decisions if you actually took into place the risk, and that was not even climate risk. That's just what a river wants to do, right? And of course, we know that with increasing climate, with warming climate, we have increasingly catastrophic events, right? So does that then turn into sort of a reactive culture that, yes, you're talking about a mature conversation where you should be thinking, okay, how do we actually look at mitigating damage in areas, putting in, building codes for argument's sake. There's a number of things that can be done in a proactive sense, or at the worst case, identifying areas which are basically doomed and let's just get the people out of them while, before there's a disaster, versus just then throwing every resource at solving a problem once it's happened, and I guess with climate change, we're going to have more and more of these, and they're going to increase in frequency. Is that fair to say? Is that the risk we're talking about here?
I think you're right, because if you look at the weight of funding, it's a while since I looked at the numbers, but we used to work in the policy advocacy space where you could see that the amount of dollars flowing to disaster recovery was far higher than preventative action, and that cuts across a whole bunch of intergovernmental and funding horizons and people, short-termism. There's a lot of factors that drive that thinking. There's also a question of who pays, right? So at the moment, you can understand why rational actors would seek to avoid losses. I'm pulling back. But the social outcome of that is suboptimal in the sense that, okay, what do communities end up with in terms of access to financial products or insurance or lending, and how does that then affect the price of their property, et cetera, et cetera. But ultimately, there's a cost associated here with how do you protect those communities that can be protected, and where does the cost of that sit? Should it be with the taxpayers, or there's a well-established principle in environmental policy around polluter pays, right? So who's actually contributing most to this problem? Should it be farmers and homeowners that cop the brunt of, a set of vested interests?
It's interesting, though, because when you think about the vested interests that have resulted in a lot of development in these really vulnerable areas, that they've long gone, right? They've made their money and gone, right? And when you look at, say, oceanfront properties in Wamberal and places like that where, big storms come in and erode underneath the cliff underneath and the houses disappear into the ocean. And there's not a lot of sympathy there because you go, oh, well, fat cats, you could afford to take the risk and blah, blah, blah. You've had an oceanfront property and that land should be public land anyway. And there's lots of those sorts of arguments. But in Lismore, my understanding, and I could be completely wrong here, but my understanding is that it's actually the lower socioeconomic area that is at most risk. It's not waterfront properties. We're talking, the affordability belt, and so these are vulnerable people who've actually not benefited financially from having been built in a floodplain or living in a floodplain. So that socially, that's got some other issues sort of tied in with it. Wouldn't you agree?
There unfortunately is quite an overlap between poor socioeconomic indicators and climate risk. A lot of land was developed probably that was cheap and maybe not suitable, particularly as you cast forward. And you can see that not just with flood, as you're saying in Lismore, but heat as well. So the way that urban sprawl has occurred, and you look at some of the extreme heat that Sydney's expected to experience. Yeah, you're absolutely right. There could be a perception that this is all about the wealthiest waterfront properties, but actually there's a high correlation between the future risks of climate change and existing socioeconomic risks. Yeah.
So that is a challenge, isn't it? Because then back to your question that you raised earlier, who's going to pay? And, it's much more, I guess it's easier to look at dealing with the stuff that happens rather than preempting. And you've got whole new suburbs with the heat island effect out there in newly developed suburbs with not many trees and lots of really dark roofs, and just a general heat, how does that feed into this in terms of the new build stuff? Because this is a whole lot of new stuff that's at risk, right?
Yeah. I mean, people were building white houses in hot areas a long time ago. I don't know how we lost sight of that lesson. You don't need to construct complex climate risk arguments to understand that a black roof is going to have a negative effect on the occupants. So I honestly can't understand some of those decisions there.
Well, that's not helping.
What are some of the major things that you're sort of campaigning for? I mean, if we sort of talk over the next sort of 5-10 years, what are some of the things that you think we need to consider from a banking or insurance point of view? Or is it maybe our build point, the way that we build homes? Obviously, we're talking about that there. There's so many different aspects to it. I mean, do we just rule out land that's going to get developed? I mean, in the Sydney floods just over the last couple of years, there was areas that just kept reflooding, right? And new housing estates are basically getting flooded. So it's kind of just give you a bit of a periscope sort of look into a few years down the line. If this just keeps happening, and there's no real way around it. But what are the things that you think we need to be working towards? Is it so many different facets to it?
So a lot of the decisions around planning get taken at the council level, and often those councils are facing a lot of financial constraints. You can see just in the rate rises that have been going on lately, just to cover, I guess, BAU activities, and you could expect that would get much worse. So what you're seeing is that the people who are, I guess, at the front and center of making these decisions are also maybe the least equipped to be dealing with them. And so there's certainly a need for high quality data to assist planning. That would be one. I think there's also a need to really use that data in a way that allows us to make decisions around future land use so that we're not writing ourselves into more problems. So let's not create more problems. And then there is an argument. Sorry, there's a second piece of work which is to say, well, of the existing property stock, what areas are likely to be most at risk, and what are the adaptations or the protections that can be put in place in order to make those communities more resilient. Now, that is readily identifiable in a lot of cases, and so that then becomes the focus of, well, planning, funding, coordination to help those communities future-proof themselves to the extent that it makes rational, economic and social sense. So that requires, I think, a different conversation, though. At the moment, I don't see a lot of evidence that the relevant actors, whether they be insurers, banks, local governments, federal governments, really looking at this from a systemic point of view. And that's been a long trend for some time. But unless those stakeholders, I think, come together and think about what the data and what the science is telling them, then we'll continue to write ourselves into more problems, and we'll continue to leave the most vulnerable at risk.
Is it a little bit like Venice, I guess? We should be thinking about ways to, not get flooded all the time and, come up with, I think even Germany, I think there was a massive river broke or something like that and flooded lots of towns and things like that. So, is it just getting the systems and the, like you say, adaptations to the way that, our current housing stock, we need to be starting to put things and bigger walls on our rivers. I don't know, it's out of my expertise, but is this one of the, rather than worrying about where we're building, we've got 11 million dwellings. We should be also thinking about, seawalls, I guess, getting built in Collaroy and, Wambrel, etc. So is that our biggest costs, that we need to be protecting our current stock, not so much worrying about where we're building the new one?
Yeah, and there may even need to be a conversation in addition to that, which is to say, does it make rational sense to try to defend everything? So what does a managed retreat look like? And that's a difficult conversation to have, right? But it may be rational that if you're thinking about the expense of adaptation and resilience planning, are there certain parts of the country where it doesn't make sense to continually rebuild and hope for a better outcome, particularly under some of the climate change scenarios, and simply think more, well, how do we reposition this as a retreat from certain areas and relocation, which is what we've been seeing.
I'm on a personal mission to help more people make better property decisions. Most people don't realise that they can cost themselves hundreds of thousands of dollars over the medium to long term when they make property decisions without all of the information that they need. And what I do is help people with tricky real estate problems, which often masquerade as simple questions like, should I sell my investment property because the interest repayments are hurting? Or should I buy before I sell? Or the other way around. You can connect with me and access all of the tools that I've created to help you make better property decisions at veronicamorgan.com.au. And there you will find resources for first home buyers, details about my buyer's agent mentoring program. You can connect with my Sydney-based property management and buyer's agency teams, Australia-wide vendor advocacy, or ask me for an introduction to the small group of buyer's agents that I would personally recommend across the country. That's veronicamorgan.com.au.
If you're looking to buy your first home, thinking of upgrading to a new one, or purchasing an investment property anywhere in Australia, we would love to carefully guide you through this journey and, importantly, get the finance right. Reach out via my website, alcove.com.au.
One thing I'm keen to understand, is how you measure and what are the key factors in measuring climate risk. And as you're talking, I'm thinking to myself of Noosa Sound, for example, which had a lot of man's intervention to change the shape of the river mouth. And then lots of waterfront expensive homes have been built on it. And every year they've got to dredge so much and they've got mitigate. There's this ongoing huge cost because basically they're just in this endless fight against nature. But, think about it, a lot of holiday homes and per amount of people per dwelling or per square metre there would be quite low. Where would there be other areas, I would imagine, where you've got more people potentially impacted, but the value of each individual property would be a lot lower. So how does all the risk get worked out with all these sort of variables?
So there'll be some risks that can be mitigated within the owner's control, and there'll be some where planning decisions will need to be taken. So just to answer your question on how our analytics work, we will take an existing set of extreme weather patterns that as of today, we will take the best climate modeling that's available in the market, and we'll look at the way that the behavior of those extreme weather events changes with respect to severity and frequency. And on the other side of the equation, look at the housing stock, how it's located, whether it's close to the sea or by a river or on a slope or in a valley, close to the bush. And as you bring these different aspects together, so the climate accelerated hazards, the contextual layers, and then looking at finally the engineering assumptions around that house. Is it 2 meters off the ground? Has it been built for cyclone standards? When you bring all that together, you can start to see which parts of the country might be affected most by when and by what. And that can be taken into account by an individual homeowner who might be doing due diligence on a property when they're buying it. It might be a bank that's seeking to assess forward risk in their lending portfolio, or it might be a government who's thinking about the resilience of critical infrastructure and services. So all those different stakeholders are looking at things slightly differently. And I think there's no easy answer to your question because they're all coming at the question from a different angle. And what I mean by that is a homeowner will say, well, I can make certain changes to my property within my control, but that may not, for example, protect you against sea level rise. It's very difficult. And so then it becomes a series of trade-offs, which is to say, well, we can't build a wall all the way down the coast, but there may be, for example, in Hong Kong, if you took an extreme example like that, that is some of the wealthiest property in the world. It's highly dense. the urban density is high, there is an incentive to protect that from a 1 meter sea level rise by 2100. That is not going to be the case everywhere. And so I think that's where the trade-off decisions will have to be made, and very much depending on how the actual science bears out. In other words, are we on a decarbonization, low carbon trajectory where we avoid the worst outcomes from climate change? That's the best mitigant. That's the argument that we try to make. Say we can talk about the cost of seawalls and all. I think, but the big question in the room is how committed are we to avoiding the situation in the first place, which is to stop fossil fuels at the rate that we are.
Is the writing on the wall though when we look around? I mean, I mentioned Venice before, but I mean, I think it's Miami's got issues with streets getting flooded. Countries like Bangladesh, I think, displacement of people, not, etc. So, is there some countries around the world, particularly say on the more affluent area, that are doing things to protect the values of property? You might talk about Hong Kong there, and some leaders in this space that are jumping on the front foot. And banks and insurance companies and governments are all coming together and actually taking action on this, or is everyone still a little bit head in the sand?
Oh, it's varies, but if you take the Netherlands, for example, where this is sort of an existential thing, then it's almost part of the national conversation. And in contrast with, I would say, if you took the UK, for example, we did some work there. We know that some financial institutions have simply said that they won't provide services into areas that they've identified as high flood risk. So that's very much a unilateral response. Then you get, as you say, more affluent countries where, if you take Singapore or Hong Kong, they can actually, they have the institutional mechanisms and the inherent wealth to be able to think about this and plan for it. And so you can see that in their urban planning. It may not be perfect, but it's not like it's beyond their capability to do so. But then you have another version of that, which might be, say, Bangkok or some of the, I guess, slightly less affluent, but more broad, not as urbanly. They're more spread out. It's harder to defend, and that's where you get tricky conversations. But also, you're starting to see capital step up there, and multilateral development banks, even private banks, coming in to say, "Look, how can we look at this climate challenge and the need for resilient infrastructure as a financing opportunity?" A lot of money was flowing into decarbonization, wind farms, solar, all that great renewables, excellent. But now people are starting to say, well, this is looking increasingly more and more like we're going to have to mobilize capital to protect some of these areas of economic production. How can we find creative solutions and funding mechanisms to achieve that? And that's not easy. I mean, a seawall doesn't, you can't put a toll on it, or it's not an attractive piece of kit. But nevertheless, I've started to see these conversations emerge. Yeah,
you could add it to the rates maybe, but I mean, is also the government challenge? Is while we're trying to fix things and build new things, other things are breaking. Floods are potholes. Our trains not working at certain temperatures, and electricity grids going down. And I don't know, there's all these other things that were built to survive, or we're resilient in these sort of conditions, but these conditions have changed. And is that they're while they're fixing, building one thing, they're trying to have to fix everything else?
Yeah, it's complicated for sure. The standards that we once built to may not hold in the future, and are unlikely to do so. And you can see in the Solhaven, where you've got probably quite a low urban density there, but a lot of roads, maintenance rates are going up. They've had a lot of natural disasters in that part of the world.
Okay.
And so it comes back to the question of who pays, because do you start slogging those ratepayers with more and more dollars, particularly in areas which are not particularly affluent? Or do you look at alternative mechanisms and go back to that principle of polluter pays, which is essentially a sector of the economy that is making a very large amount of money out of exporting fossil fuels overseas. And yet really bears very little responsibility for the indirect impacts that it has on the wider community. So that that's obviously entering into, a lot of climate politics, but it seems unfair to slog homeowners, ratepayers and farmers with the costs of climate change when people are using the atmosphere as a dumping ground rent-free. So that's a topic for debate, I think.
It's it's an interesting topic. I mean, the mining tax wasn't really about fossil fuels or trying to sort of tax emissions. We had a carbon tax that, one government sort of failed. Well, a mining tax and carbon tax, they both failed politically, really. They've very powerful lobby groups, these polluters. It's like we can all talk about this stuff and know that that's not going to happen. So fundamentally, we are all going to have to pay, but some people pay more than others, right? Obviously, if you are one of those people who lost your home to a bushfire back in 2020 and you're still living in a caravan because your house was uninsured or whatever, or you still haven't got a builder, or for whatever reason, you're paying a disproportionate amount for for this problem. And I guess too, if organisations such as yours is quantifying these risks and pinpointing areas of greatest risk, and you've said there's a correlation between those at greatest risk and low socioeconomic areas. So, and then we don't want to pay more rates, and we don't want to have our cost of living going up. It's
very tricky. Yeah,
it's a very tricky, isn't it? Because also you've got a situation where, you hear the bleeding heart stories on the news always, and even when somebody wants to do a new story on first home buyers and we get contacted as, can you give us an example? And we want a bleeding heart story. It's like, and nearly every time there's a major flood or a bushfire event, you get an interview with somebody who bought their home 6 months earlier and then discovered it was going to cost them 20 grand to insure it and didn't insure it and then lost it. That type of scenario. So
I think that's yeah. So I mean, coming back to, I guess, the nuts and bolts of it, there are a few things that people could do. So one is when you're buying a property, think of the future insurability of your property and its exposure to natural hazards, extreme weather events as part of your due diligence. And this is not a plug for what we do, but we do make those analytics available to people on a website called Climate Valuation. So you can go and have a look and get a free check. And if you want a deeper due diligence on the property, if you do see a risk, then there's a more detailed report that can be purchased. The other thing I think, of course, is to start asking, because if people don't ask, then the information is not going to come, right? But if enough people say to their insurers or their banks, do you have any information that would help me to understand whether my property is going to become more expensive to insure in the future? Could you share that with me and why? And I that they may receive an imperfect answer, but at the same time, it does start to prompt a response from these service providers to say, maybe we do have a duty, or at least it's good corporate citizenship to make available either some kind of information or buyer beware type recommendations, which is to say, before you enter into this 30-year commitment on a financial instrument, these are the things that you might want to think about with respect to this property, or just in general about property purchasing with respect to extreme weather events. So that's there. Then I think where this goes is there is an opportunity to help people here for financial institutions. It's not certainly not a space for antagonism, because what can flow from this is just that as financial institutions have stepped up and said, we'll give you preferential rates to put a solar panel or energy efficiency on your home, there are, as I said, there is a large amount of the housing stock that we're talking about that could be adapted for future weatherproofing. And that will require funding. That could be structured within the mortgage, and it could form part of the next wave of green products. So I think there's lots of good stuff that can happen there. For the really extreme properties that are looking, like it's quite hard to defend, we're only talking possibly between 2 and 5% of the housing stock in Australia under some scenarios. Like it could get I mean, there's obviously uncertainty in those ranges, but what I'm trying to say is that there is still a substantive opportunity for private enterprise to help homeowners and investors in this area through some, I guess, the next evolution of green products.
Well, it's funny. I've just thrown my property into climate valuation, and I was a B, but by 2050, I'm a C. Another C by 2100, obviously, if I'm at 2050. So, what does that sort of, when someone does throw their property address in there, what does that actually mean, though? When you're saying that properties are higher risk, like, is it a really good way for people to understand, actually, maybe I shouldn't buy these property if it ticks certain ratings, or I've just got to be conscious that maybe insurance is going to start to become more and more of an issue for me, and maybe I need to think about, be careful, like self-insuring and making sure my property is, protected, I guess. Like,
yeah. So just to break down what that rating means, it's making a series of assumptions in the background about the type of property, but it has taken your address, geolocated it, taken in those contextual layers, and applied the extreme weather events that I mentioned before. Now, the idea of that free feature is that it gives a bit of a signal that if you're getting a C rating, then you probably want to go into a little bit more detail, and you can tell the system more information about your home in the comprehensive report, which is to say, I estimate that it's 2 meters off the ground and not the assumed 0.5 meters, or it's built in this year and it's made of these materials, and I know a little bit more about it. And so what the system is doing is starting to accommodate for that information, which may tell the system that it's actually a pretty resilient asset. Like if you buy a Queenslander that's built 3 meters off the ground, they've been around for 100 years and it might be fine. But if you're buying a slab on ground property in a zone that's just been, developed and maybe in a floodplain under certain conditions, then the system's going to flag that for you. So what it allows you to do is to explore in a fairly granular amount of detail. If I tell the system this amount of information about my property, it can give me a pretty good indication of future risk. Now, that risk is measured primarily by the expected cost of damage under a certain event due to climate change. So it's measuring the cost of a flood affecting the floors, a fire burning down, or extreme wind blowing the roof off, and it's taking the cost of that damage and then expressing it as a fraction of its replacement cost. So if you've got a replacement cost on a home of $1 million, and the system has calculated that within a year, the average expected cost of damage due to extreme weather under that climate scenario is, say, $10,000. 10,000 divided by $1 million is 1%. And it's saying 1% is actually quite high. It's saying that for that year and for the rest of the property's life, you're going to have to pay 10% of its replacement cost either on insurance or damage repairs. And so it's not to scare people, but it's just to give them pause for thought and go, well, is that something I can afford? Is that a risk I want to take? Is it an issue that I want to investigate a bit further? And they may get someone in on the ground on site to have a look at some of those issues, just as you would a pest inspection or a strata report.
Yeah.
And it's not, it's as I said, some of these properties that are getting flagged are probably 5 to 10% of the total property stock. And so it's not like everybody has to go out there and check this stuff all the time, but it is sending up a trigger sign to say, under these assumptions, there could be a risk that your insurance premium will change materially over the life of that loan.
And are insurance companies using similar, your data? I mean, or something similar if they're not using yours?
Yes.
Yeah. So the fact is that, the insurance company knows this, so you should know this. What about if you're already an owner, though? Like I am an owner. I've owned it for 10 years. It wasn't a problem before, but now it's becoming increasingly a problem. I guess it's hard to jack up a house 2 meters, particularly if it's actually on a slab. But I know Queenslanders get jacked up all the time, and then they fill in the bottom, which is sort of defeats the purpose in some ways. But because that, I would imagine that that's a big issue. If you're saying 5 to 10% of the housing stock, that's up to maybe 1 million, maybe 1.1 million dwellings. That's quite a lot. It's quite expensive.
And they could be affected in different ways. So when I talk about those numbers, I'm talking about a situation where we fail to address the decarbonisation challenge. So it assumes that we're on the trajectory that we're currently on, which is to say we're not performing too well when it comes to meeting so the goals of the Paris Climate Agreement or our renewable energy targets, those sorts of things.
Yeah, okay.
Now, the great mitigant in all of this, of course, is people going, hang on, I don't want to be looking at a future like this. We need to do more to actually address the underlying causes of climate change. And that's where you see, I guess, dual policy responses. One, of course, is to prepare for the worst. But the greatest mitigant to that is accelerating our commitments to decarbonize the economy. And so that's the economic case for action for climate change, because like you say, that is a lot of dollars. Yeah. But we don't have to spend those dollars if we achieve on the other side of the equation.
But it feels a bit like it's turning the Queen Mary around, like it's and if we do get a federal government change this year, that's going to put it back even further, no doubt, because they're not known for, the Liberal Party is not known for its climate action. So, and there's still a lot of pressure against. Anyway, I was reading an article in the Herald about these carbon forests and how ineffective that as a policy has been. You know what I mean? There's all these policies. None of this will be quick in terms of if we actually lock into something that works, it's not going to suddenly decarbonize the atmosphere and the planet and all the rest of it. So in the meantime, you've got to be thinking very seriously about what you own and what your risks are right now. And I think that we'll put the link in the show notes as to that valuation, the climate valuations, because I just think that as property owners or buyers, we do need to start to understand what our personal obligations or risks or costs or whatever are going to be.
Yes, I would love to see this move into the space of consumer protection in some ways. I mean, there's a counter argument that, this is uncertain and, but I think we're seeing that argument falling away increasingly when you see what's happening in North Queensland or you see what's happening in LA. Those arguments don't stack up quite like they used to. And whilst you don't want to be scaring people unnecessarily, there is a healthy conversation to be had around the fact that what you assume to be true today may not carry forward 30 years when you're signing up to a 30-year mortgage. And that's something people should go into eyes wide open. And they may take the call to say, yep, I can afford that. That's fine. Others may not and should proceed with caution.
So, Phil, there's, obviously fire. People get that. Flood. People are understanding that. What are some of the other ones that I think people aren't misunderstanding? Soil. Like there was this it's not funny. I was going to say funny because it's not funny. But there's a property that is up near me, and we were buying a place up on the beaches in Sydney. Back in 2019, and we were looking at. You're always at the mercy of the market when you're buying, right? So you got the ideal view of what you want to buy, and then you got out there hunting, and you got what's on the market, and we were getting more and more desperate, baby in the belly. Even though I do this every day, we were emotional. And this property came on. We were looking at this is our best option on the marketplace. We went and looked at it 3 times, got a building and pest inspector out there. And he's like, mate, do not buy this property. And I'm like, no, we love it. It's really good. It's got a great view. And he's like, do not buy this property. This could fall down.
Right.
Anyway, that's 2019. So I drive past this property all the time, and kids are losing it, and I want to get them to sleep. So I'm like, I'm taking you guys for a drive.
Is it still standing?
Well, so and the interesting thing, next door actually burnt down. The real estate agent accidentally burnt the house down next door.
Don't think that's in our models.
No, it was just dropped the It was actually
Drop
she was
your
renting
ciggy out the back.
No, no, she was agent was there's probably a dumbo, but the agent was getting it ready for a tenant inspection, and the tenant had a candle and she put some clothes on it. She's ended up it's gone to court and everything anyway, but she started a fire, the agent.
Yeah, I wonder about that sometimes.
And she's gotten a lot of anyway, poor thing. Yeah. And she's just trying
doing
to
her
rent
best.
The property out. She doesn't mean to burn the house down. Anyway, so that house is still not been renovated. There's, gates up at the front, and this is on, Riverview in Avalon anyway. Anyway, I've just driven past the house the other day, and I'm like, oh my God, the thing's falling over. And there's these huge retaining walls, and they're using timber as well, which is probably not the best, choice of materials, but they're trying to retain in front of the retaining walls. And I mean, this is just general soil
erosion.
Erosion. But, that's, I guess, is part of it, right? What are the things?
Down in the Mornington Peninsula? House slid down the embankment.
Yeah, that's another one.
And they're saying that the increased, groundwater or something is actually destabilizing the whole plateau or the whole hillside there or whatever, and all their houses are at risk. Apparently, that's what I was reading about. So this is a change, right?
Yep. No, there's. It's getting doomy.
But remembering at this stage, there's only 5 to 10% of Australian properties.
Well, in that situation, we had to convince her. I was looking at the wall. I'm like, you know what, you're right. And Melanie, my wife, and I were like, yeah, looking at that wall, that does look like if that goes, that house is going.
Yes.
But years ticked over, and the wall was still there, and I was like, fine, they're not doing anything about it. And then I went past it. I was like, oh my God, that looks like it's all collapsing. And then next week I drove past, and bang, there's all these retaining walls up, and they're trying to save the house.
Wow.
And so
it's awful,
that person bought that property back then. They paid a big price. It didn't go cheap. It didn't get discounted because of the risk. It actually went, well over what the price we thought was, not ridiculously, but right at the top of the guide, over the guide, and then another 10%. But that person was not factoring any risks, and our building inspector was saying, mate, this property is going to fall over. So
yeah. I mean, look, you did the right thing, which is if you're going to sink
Lucky.
what I assume to be quite a sum of money into a single thing, you want to kick the tires on it. And I think that's an argument that sits outside of climate. But climate is just an accelerant to some of these factors, right? The bottom line is probably those geological issues would have manifested whether it's climate or not. But in what we can say is that the increased frequency and severity of certain events, whether that be increased rainfall, drought, extreme winds, bushfire events, etc., effectively accelerate things that we took to operate in a sort of a normal distribution is to be far more frequent and extreme. And so that's sort of just a mindset that people might take if they're looking at buying regionally, for example. Has there been an historical flood in the last 100 years? You could assume that under certain climate conditions that the frequency of that event may be far shorter. Has there been a bushfire in the area, and do the conditions just simply been allowed to come back to as they were?
Build up.
Would you buy so there's sort of some common sense things that can be applied here, but some of the more hidden things could be soil substance, where you get reactive clay soils and the increased effect of drought leading to cracking in certain foundation structures, which is a big, my mum's had that problem. And I think the other sleepier issue is that as climate change worsens, it's projected that cyclonic activity will shift further southward in an Australian context. So what that means is that once you pass a certain point in Queensland, houses aren't designed to cyclone standards anymore. And so what you have is higher exposure in places, like Brisbane or northern Queensland, experiencing extreme winds that they may not have had before, and the building standards don't have those
capabilities,
same requirements that you would have seen north. So those sorts, I'd say they'd be two things for people to think about.
Well, this has been a very interesting conversation. Not exactly enthusiastic, but it's enthusiastic in terms of encouraging awareness and, encouraging, I guess, our understanding of the severity of not doing something about our fossil fuel consumption, for starters. Do you have an example of a property, Dumbo? Not that we haven't been talking about them all the way along here. Do you have an example that, a story that we could all learn from to wrap us up here?
Yeah, I mean, just talking about, we bought a slab on the ground property in a regional area without checking the soil underneath, and it was reactive clay soil. And actually the building inspector didn't pick up on the fact that the slab had snapped at some point in the well before we purchased it, and that has affected the structure of the building. And fortunately, it wasn't massive outlay, but at the same time, it was something we missed, and certainly I wouldn't want others to have to go through.
So you've got personal experience. I do. Well, thank you, Philip, for sharing a personal dumbo as well. I think that's always a brave thing to do, and we appreciate that. Thanks for coming along, and also I'm going to shout out to the listener who actually put you forward as a guest and suggested you reach out to us, because the listener is listening and understood that we do want to talk more about this. We do want to raise awareness here, because this is something that is a growing issue for homeowners, but also for home buyers. And we all need to be better informed so we can make better decisions across the board. So thank you so much for your time.
That's a pleasure. Thanks for having me. Hello, Elaine. That was my friend.
Oh, hello, Elaine. Shout out.
Thank you. Nice to have a chat to you both.
Awesome chat. Thanks, Philip.
Thank you.
If you have a question that you'd like us to answer in an upcoming Q&A episode, you can send us a voicemail or written question via the website, theelephantintheroom.com.au, or you can email us directly at questions@theelephantintheroom.com.au. If you like what you're hearing, please share this episode with others you feel would benefit. And while you're at it, why not leave us an iTunes review? 5 stars would be great. I know that sounds a bit cringy, but we have it on good authority that every review helps make it easier for other people to find out about us and hear what our amazing guests have to say.